Success in the market is dangerous. It breeds a specific kind of arrogance where a single, narrow win convinces people they understand how the entire system works, leading to decisions where everything eventually collapses. Take the historical example of the shoe button king. He was an entrepreneur who managed to completely corner a tiny, highly specific niche, the market for shoe buttons. Because he dominated that one narrow field, he assumed his brilliance applied everywhere. Suddenly, he viewed himself as an authority on complex topics like human health and relationships, lecturing his peers on subjects he actually knew absolutely nothing about. Warren Buffett built his fortune by actively avoiding this delusion. He recognized that lasting wealth doesn't come from pretending to master everything, but from ruthlessly ignoring almost everything. To survive the market, you have to set aside your ego and adopt his method, a strict three-part mental gauntlet designed to filter out the noise and strip away weak investments before they ever reach your portfolio. The first line of defense is defining the absolute limits of your knowledge. If a company falls even slightly outside your personal or professional expertise, you must throw it out immediately. This is a close-up of an integrated circuit board. Despite the massive profits generated during the tech boom, Buffett refused to buy into the sector. He freely admitted he understood about as much about semiconductors and these electronic pathways as he did about the mating habits of insects. You build your own filter by staying anchored to your daily life and education. A medical student reviewing pharmaceutical trials has a severe structural advantage when investing in healthcare stocks, while an electrical engineer is perfectly equipped to evaluate the energy sector. This logic also applies to geography. By keeping your money in domestic markets, you invest in a regulatory and consumer environment you naturally navigate and understand every single day. Passing on a booming tech stock you don't understand is not a missed opportunity. It is a necessary precaution to shield your capital from catastrophic, uninformed losses. Even within your area of expertise, your financial calculations will occasionally be wrong. The second filter demands you account for human error by insisting on a steep price discount. Imagine you are an engineer designing a bridge. You calculate that the heaviest trucks passing over it will weigh 40 tons. If you engineer the supports to hold exactly 40 tons, a tiny miscalculation in the steel's carrying capacity guarantees a collapse. You build it to hold 60 tons, so the structure can absorb your inevitable mistakes. The same exact math applies to valuation. If your research indicates a company is intrinsically worth $50 a share, you wait until the market panics and prices it at $40 before you buy. That $10 gap is your buffer. Buffett's mentor, Benjamin Graham, took this to the extreme with his cigar butt strategy. He hunted for cheap, unloved businesses where the total liquidated value of their physical assets was mathematically higher than the current price of their stock. If the underlying business ultimately fails, you can still sell off the parts for a profit. The margin of safety acts as a mathematical shock absorber, ensuring your bad calls don't erase the gains from your good ones. In 1959, Charlie Munger convinced Buffett to evolve past strictly buying cheap companies. He argued that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This led to the ultimate filter, the toll bridge. At one point, Buffett and Munger actually owned a 24% stake in the Ambassador Bridge connecting Detroit and Windsor. Once the bridge was built, they could raise the tolls indefinitely because customers physically had no alternative route across the river. You find these structural monopolies in modern markets through intangible assets. A global brand like Coca-Cola forces competitors to spend billions in advertising just to be noticed. Network platforms like YouTube become increasingly valuable. Then you have stickiness. When enterprise software products require hundreds of hours and millions of dollars for a client to learn, the sheer friction and cost of switching to a competitor's system locks that customer in place. Finally, there are high setup costs. Industries requiring massive initial capital investments naturally repel new competitors. Trying to lay down a second railroad line or physically duplicate an established electrical grid next to an existing one requires risking billions of dollars before you ever acquire a single customer. Once you find a business that passes this final filter, your active work is done. The toll bridge's structural advantage will continually compound your wealth without you ever having to interfere. Long-term investing is not about predicting the future with perfect accuracy. It is about relying on a system that severely limits your exposure to ignorance while holding on to assets with deep structural advantages. You outline the exact boundaries of your competence, demand a mathematical discount for errors, and acquire toll bridges. This strict elimination process keeps you grounded when the market charges blindly into a speculative bubble. Take the time to build your own strict gauntlet today. Map out the exact boundaries of what you truly understand, and look for the hidden monopolies operating right in your own backyard. In 1999, as internet stocks surged to dizzying heights, the investing public became convinced they had found a shortcut to endless money. They justified sky-high valuations by calling it a new paradigm, throwing their capital into hyped-up dot-com companies while expecting annual returns of 20%. But the man who eventually became the richest person on Earth completely ignored the frenzy. While the crowd bought in at record highs, he refused to participate. That investor is Warren Buffett. By dedicating his life to reading annual reports and studying businesses, rather than trying to time market swings, he grew a small sum of $1,000 in the 1940s into $86 billion by 2018. Yet he rejects the typical markers of that fortune. He avoids collecting luxury cars, purchasing fine art, or sprawling real estate portfolios. In fact, he still lives in the same house he purchased a half-century ago. This record is the result of two systems working in tandem. First, a self-funding mathematical loop that accelerates capital growth, and second, a behavioral framework that filters out market noise. That first system relies on the mathematics of compounding income. At its core, compounding means your money earns a return, and then that return generates its own profit, creating a cycle that feeds itself. This chart illustrates the logic. Imagine a job where you work 8 hours and earn exactly $100. But on day 2, your manager hands you that same $100 after only 7 hours and 50 minutes. By day 3, you get the exact same payout after just 7 hours and 40 minutes. The reason you earn the same amount with less physical effort is because the work you completed yesterday is actively assisting you today. The more capital you have in the market, the less energy you expend to generate the next dollar. Buffett discovered this as a teenager by placing pinball machines in local barbershops. As soon as one machine generated enough profit, he used those earnings to purchase a second machine, instantly doubling his growth rate. He found a similar lesson studying public weighing machines. By extracting a tiny 1-cent fee every time someone checked their weight, an owner could fund a second scale and then a third, rapidly multiplying their earnings without extra labor. Eventually, Buffett took this concept to a global corporate scale. He transformed his textile company, Berkshire Hathaway, into a diversified insurance business. This diagram shows how an insurance company generates float. Policyholders pay their premiums up front, while the company only pays out claims at an unknown later date. This creates a sizable pool of available cash that Buffett can invest for his own gain long before he ever has to cover a loss. By saving his early profits and leveraging the structure of insurance float, he built a financial system that essentially runs itself. But even a perfect system fails if the operator panics. That brings us to the second operating system. To keep that mathematical engine running, an investor needs a psychological barrier to block out the friction of market cycles. Buffett describes the stock market in the short term as a voting machine. On any given day, stock prices reflect popularity contests, public anxiety, and the reactive behavior of the crowd. However, over the long term, the market functions as a weighing machine. Eventually, the hype fades, and the price of a stock will strictly reflect the actual profits and tangible output of the business. This graph maps 1964 to 1981. The Dow Jones Industrial Average remained completely flat, yet actual economic output grew 5 times larger, exposing a stark disconnect between what the public felt and what businesses were actually achieving. Most investors missed out on this expansion because they were focused on the daily voting. They wrongly believed the rules of the game had changed and abandoned their strategy just as the economy was scaling. Without a psychological filter, an investor will continually interrupt their own compounding. They will react to the crowd's votes rather than waiting for the scale to reveal the true weight of the business. To maintain emotional distance from the crowd, Buffett utilizes a behavioral tool called the inner scorecard. He poses a philosophical question to illustrate it. Would you rather be the world's greatest lover, but have everyone think you are the worst? Or would you rather be the worst lover in the world, but have everyone think you are the greatest? Choosing the reality of being the greatest means you are guided by an inner scorecard. You base your worth on facts and your own reasoning, which makes you immune to the temporary opinions of the market. Buffett's skill in identifying undervalued companies is secondary to his total indifference to other people's opinions. He does not need the crowd to agree with him to know he is right. Long-term wealth generation is an interdisciplinary challenge. It requires the humility to value every single dollar to feed the engine, and the fierce independence to protect that engine from the noise of the world.